My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I've been to make friends. I'm just trying to make you a little money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Something's very wrong here. We've seen so many articles and data points that show there are real cracks in the economy. Hardly a day goes by when we don't hear that higher interest rates are starting to stifle business. In the last 24 hours, I read an article about how vehicles have gotten too expensive and defaults on car loans are rocketing. I've seen pieces about how houses are just way unaffordable. About how job hopping is no longer an option. Job firing is more like it. Now tech spending, thought to be so vibrant, is beginning to get scrutinized at even the highest level. And I'm not just talking about enterprise software. I'm talking about cybersecurity software. That's like skipping on fire alarms and smoke detectors. And sure, the averages keep getting hit. The Dow lost 175 points today. S&P declined 0.28%, but the Nasdaq did advance 0.06%. But man, this market's just not trading like we're headed for a recession. The stocks aren't saying it, even though the news articles say they are. Everything I just listed is a sign that businesses are pulling back from their spending. They're worried about labor strikes. They're worried about the health of the consumer. They don't want to invest too much, and they may get hit for a couple more rate hikes from the Fed anyway. The consumer's not that much better. We heard a downbeat tale from Macy's about the future, even though their numbers were good. It's in keeping with my takeaway from Walmart, which is doing great because people are trading down to their much cheaper store brand, but the people are worried about it. The market's worried about whether Walmart will have any sales going forward that are anything worth writing home about. Meanwhile, the housing stocks have finally hit a wall as mortgage rates have moved up considerably, while hobble banks scramble to find some credit to give customers. The banks are doing worse than home builders. Toll did report a decent number time. But you can paint a pretty ugly picture here. But if all these issues that we are reading about, if all the data points are real, if we're truly headed into a serious slowdown, why does this market hate the slowdown stocks? The ones where you're supposed to buy when you see the kind of action that we're getting from the news headlines. They've been a cascading nightmare, though. Some say it's because many of them are dividend stocks and people want nothing to do with them now that bonds can give you better yields. The thing is that misses the whole point of what's really happening in the slowdown. The consumer retrenches and goes back to the store to buy goods. She's trying to find ways to make the dollar stretch a little further, especially if she's trying to pay off student loans after a very sweet hiatus. I don't know if we're headed for a slowdown. But I do know it makes sense to dip your toe into the consumer packaged goods stocks, true recession stocks, if only so that you'll have all your bases covered, and because they've gotten cheap. Let me tell you about the ones that make the most sense in what has become a bear market for the consumer packaged goods. All right, the two easiest consumer packaged goods stocks to recommend to you right now are Pepsico and Mondelez. Enter some nice sideways to down action. The stock of Pepsico is truly unusual. Here's a company that beat the consensus estimates 18 consecutive times, gave you one of the biggest forecast boosts. Frito-Lay had a terrific 14% organic growth. Even the carbonated business, which I've been giving up on that, had double-digit growth. The typical analyst reaction, Weber's took its numbers up big, talking about how Pep could earn $8.09 per share for 2024. Now, with the stock having sunk from 170 to 175 from 196, even as commodity prices come down, I think PepsiCo's stock has gotten too cheap to ignore. It is a really well-run company. Mondelez may even be better as a stock. It gave you a robust outlook. It raised its organic growth forecast from 10 to 12%. Unlike most of the packaged goods group, Mondelez had organic sales growth of nearly 16% this past quarter, driven primarily by price increases with flat volumes. The norm for most of these companies has been volume declines as they try to push through even modest price increases, and the consumer has started to just say no at the supermarket. But here you have a more than 15% grower on a constant currency basis, meaning after this decline, it sells for 20 times next year's earnings estimates. Remember, if you can get a company like Mondelez that's growing at 15% for just 20 times next year's earnings estimates, and those earnings are actually accelerating, that's a very positive situation. Mondelez is just terrific here. I don't care what the economy does. Now, there are a lot of anomalies in this consumer packaged goods group right now. Procter Gamble, for example, saw hair care up high single digits, skin and personal care up low teens, and grooming up 8% as higher pricing stuck while their cost of goods dropped, leading to real nice margin expansion. Procter is one of the better stocks, and it reacted exactly as it should respond in a quarter. It ran from 150 to 158 after spending time in purgatory of the 130s and 140s. But now P&G stock's been crushed. I'm beginning to wonder whether it's time to buy the stock back that we sold for the charitable trust at a much higher level. I simply cannot believe how quickly those gains were lost if you stuck around, even as Procter raised its forecast and was getting congratulated by analysts in the call. It's like they never put up that shocking 13% earnings growth number. It's astounding to me how badly that stock acts. You want a real consumer packaged goods company that's just plummeting based on nothing? How about the stock of Hershey? Here's one that has gone from $276 to $213 without a peep, although I do like peeps the candy, as the analysts are afraid of trying to catch a falling knife. Meanwhile, what did Hershey do wrong? Well, they reported a 10-cent earnings beat off a $1.91 basis, 12% growth. They raised their guidance to 11 and 12%. They talked about gross margin improvement in the second half. Hershey's opening 5 new manufacturing plants just to meet demand. But they didn't raise their forecast for 2024. Purely because they prefer to be conservative. Oh, yeah, Hershey had a good quarter that was met with a bad reaction. But if it reports the same number today with a slowing economy and the stock down $60 from its highs ahead of a good Halloween, I bet there'd be takers. Buy. We had Clorox on the show recently. Its raw costs are going down as its prices go up. A heck of a combination. Wall Street thought that Clorox could do $1.8 billion in sales, but they managed to do slightly more than $2 billion. A remarkable feat for what used to be a bit of a disappointing company, but not anymore. I saw so much to like about the Clorox quarter, with 3 of 4 reporting segments exceeding sales estimates. The earnings were strong across the board. Gross margins were an astounding 42.7%. Analysts were only looking for 37%. Wow, this quarter was great. CEO Linda Rendle is turning this place around, and I think the stock's ready to launch. Best of all, thanks to recent decline, you're now getting the latest quarter for free. Highly unusual if we really are in a slowdown. Yeah, I can mention SEC, Constellation Brands, but hasn't really given up enough of its gains to be truly enticing here. We own it for the trust. The Mexican beers, Modelo, Corona, and Pacifico, are just too popular. Finally, if you really buy all this bad news about the economy, maybe it pays to buy the worst performing consumer packaged goods, the one nobody wants, like the ones at the 52-week lows, like Campbell's Soup, which is breaking down off kind of an okay quarter, even as it made a stirring purchase of the parent company of Rao's, the great sauce company. Kellogg's been hammered, but they're breaking it up into two companies, a snacks company and a cereal company. And at these levels, the stock gives you a nearly 4% yield. Kellogg and Campbell's down so much, they're starting to look up to me. Bottom line, none of these recession stocks work if the economy stays white hot, but they make for good protection in case Jay Powell says something really harsh on Friday that makes us terrified of a slowdown. I like Pepsico and Mondelez the most. They can be bought right here, although you've got my permission to buy any of the ones I just mentioned, because your portfolio at this stage of the game does need the insurance of a slowdown stock. Let's take calls. Let's go to Josh in California. Josh.
Hey, Jim, here's a triple booyah for you.
I love a good triple booyah to start the show. What's up?
My question's about Southwest Airlines. I own it, and I'm currently in the red, and I've noticed a lot of analyst downgrades in the past month. So should I buy, sell, or hold the stock at this point?
You know what? I don't like the way the stock acts. I don't like how the company's doing. I think you can hold it, but don't buy any more. I mean, sometimes we own stocks for the trust, and I buy a small position, and I just watch it. And if it's really bad, I just don't buy anymore. Just let it go down. I shouldn't. I should just sell it. But I have a history, unfortunately, of a couple really bad ones, and Southwest is a real bad one. What can I say? Let's go to Dennis in Massachusetts. Dennis.
Hey, Jim. I'm great you got me on. I'm very interested in your thoughts on the increasing competition in the streaming industry and how it might affect Netflix's market share.
Okay, well, all I'm going to do is refer you to the actual calls of Netflix where they talk about the competition and how it hasn't really hurt them. And I think that they've been very right. I think Netflix, I'm worried about a writer's strike that goes on forever, but Netflix is a very good company, and I've been in favor of it for a very long time. All right, your portfolio needs the insurance of a slowdown stock, especially if Fed Chief Powell says something really harsh on Friday that makes us terrified of a slowdown. My favorites are Pepsico and Mondelez. On Mad Money tonight, we are continuing our series on August losers that may be worth looking at by revealing 5 more beaten down names that I kind of find enticing. You don't want to miss it. Then, as we know, the stock market is pretty much hostage to the power of the bond market. And with the 10-year yield hovering near levels we haven't seen in 16 years, what could that mean for the broader averages? I think we got to go off the charts to find out. And from the professionals to the at-home handyman, where do home improvements stand as we emerge from the major COVID-induced boom? I'm getting a read on the sector with the fabulous CEO of Lowe's. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.